Okay, welcome to a new class basically. So we're still taking orders. Yeah, I know we're running behind schedules basically, but it's all in the plan. So have some patience, okay? Of course, you get to see the distribution. I've said that already, so I'll make sure we all get just that we have slight delay in the processes, but then we're almost there. Okay, now remember that we've been talking about shares. That's an arrangement where the business tries to raise funds by selling part of its ownership. Okay, so what you're saying is that you're technically increasing the number of business owners such that you raise money for the business, right? That's shares. We talked about that in our previous classes. Okay, now aside from raising funds through shares, it is also possible to look at the option of raising funds, okay, through debt acknowledgement. So what it means is that you are trying to raise funds or raise money, let's use the simple word money, okay, from individuals or business organizations that are involved in or interested in investing in businesses, okay, such that there is this sort of relationship of should I call it lender and debtor relationship. So what I'm saying is that instead of raising funds such that the person that is bringing in the money to the business becomes part of the owner of the business, instead of doing that, this arrangement allows you to raise funds such that the person through which money is being raised gives money to the business, but in this case the person is not becoming part of the owner of the business. Instead, the person is what they call a creditor to the business. So in that sense, what it means is that while the person is interested in investing in your business or in the business, okay, by putting down some amount of money, the person is going to have what they call a bond or an agreement, okay, such that the person earns an interest, okay, over an agreed period of time before getting back the money invested in the business. So if, for instance, there's an agreement to raise, let's say 15 billion naira, okay, let's say 15 billion naira, okay, through this option or through this method, okay, so the bond arrangement allows the business to raise the money at a fixed interest, okay, over a specific period of time, okay, such that the business becomes indebted to that person over that period of time. Okay, now such an arrangement is referred to as bonds, okay, or popularly called debentures. Okay, so now when I use the word debenture, I might be referring to bonds, and when I'm using the word bond, I'm referring to what debenture. Okay, so the debenture here is like a bond of what debt acknowledgement. So we can call it bond of what? Debt what? Acknowledgement. Okay. So what we're saying is that what there is an agreement, okay, such that the business is what accepting the fact or the liability of the fact that it is owing a particular person amount of money for a period of time at a fixed what interest. So sometimes we refer to these guys investing in this sort of arrangement. We refer to them as debenture holders. So now I know if you were selling shares, you call them what? Shareholders. So these ones are like owners of the business. So they are entitled to dividends, right? So it means that most times they wait for profit before they get reward. But here, debenture holders, or what you can also call debt holders. Okay, they are those that invest in bonds or debentures. Okay, but in this case, the relationship is not ownership relationship. You know, shareholder here is ownership. Okay, but here it's more of what a creditor relationship. So what we're saying is that what these guys are more like creditors to the business. That means the business is owing them. So, and the business is expected to pay them their fixed interest, whether profit is made or not. Okay? But here, the shareholder relationship here, we're saying you're part of the owner of the business. So it means that if there's a profit, then you get paid. But in this case, okay, whether the business makes profit or not, these guys get paid. So relationship as a debenture holder is different from what relationship as a shareholder. So now, of course, when you look at the word bond, okay, or you look at the word debentures there, you can have various arrangements. You should look at your karma, okay? Karma also helped us, to look at the various arrangements that can come around with debentures. There's something called irredeemable debenture. Karma used the word perpetual. Okay, what it means is that the debenture or bond arrangement with the business and the investor, exists as long as the business exists. Okay, of course, where we have issues surrounding the continuity of the business, then the debenture holders, have rights based on the arrangement in the bond to retrieve their investment. Okay, so we call it redeemable debenture. Of course, Kama used the word perpetual. So we can have redeemable debentures. Of course, that means there's a fixed period of time, okay, with which the bond will exist. And then we call mortgage debenture. What it means is that the arrangement allows the debenture holder or the debt holder to lay claim on certain part of the asset of the business where there is a threat to continuity or survival of the business. Okay, so we have what we call maybe simple or naked debenture. So various arrangements will result into various nomenclatures used to describe the sort of bond that you're into. Now, if we accept the simplicity of finance, okay, of course we look at it, that finance can be modeled, okay, such that we derive various options to suit various businesses, of course depending on the area of the net of the law that you are falling under. Okay, so that's the simplicity of finance. You can have these sort of arrangements to suit various businesses. Of course, in these days we have various loan apps now trying to give loans to businesses. That's another arrangement as well. Of course, there are issues of some of them not being licensed and all that, because that is not for us to discuss, but these things are there. Okay, but be careful so you don't enter into those sharp nets. Okay, so now here, what we're trying to say here is that if a business is involved in bonds, of course, in recent times, various states basically have been involved in raising funds through bonds. I think Kwara State did one recently about 35 billion. Lagos State is also looking at what they call green bonds. This finance thing there. Green bond is also a bond area, but in this case it is tailored to a particular area. I think more of bonds structured to help solve environmental issues. Okay, so you can read that up. I think Lagos State is doing that now, trying to sign something of that nature. Okay, but the idea here is that when we look at bonds or debenture, uh, we are saying that so what we are saying is that the business or the organization is trying to raise funds through an arrangement where the investor gets to finance or send money or give money or borrow money or lend money to the business at a fixed interest over a period of time. Okay, and then that can be tied to either assets of the business, existence of the business, and all that. Okay, so you can actually look at your karma to understand, those various areas. But then, looking at the accounting aspect of it, so long as we're agreeing to the fact that the person that is investing into the business is not uh, is not referred to as a shareholder, or is not trying to buy into ownership of the business. Rather, the person is investing as well as a creditor. Okay, this makes it clear. It means that the venture holders are more like what do you call them now? They are like creditors. So it means that they are liabilities to the business, right? So in this case, why they are liabilities, what sort of liabilities do they fall in under? Is it the current liability or the non-current liabilities, or what we call long-term liabilities? Okay, so the venture holders, basically by the nature of the bond arrangement, most times the bond arrangements usually take more than one accounting year to liquidate or to settle. So in most cases, as a matter of fact, usually the venture holders are classified as what? Long-term liabilities, or what we call non-current liabilities. Of course, the interest earned on the investment is usually an expense to the business. So where it is not paid in the accounting year, it forms part of the liability of the business. So if we look at the venture holders investing in the business, it means that it will flow through liabilities and then flow through what? The bank. So it means these guys are going to pay money to the bank of the business, okay, which happens to be what? An asset. And then that will also return to a liability, right? Because they are owing the business. Sorry, they are owing the investors. Don't forget that your assets, when they increase, what do? You debit. When they decrease, you credit. Liability, when they increase, you credit. When they decrease, you what? Debit. So when somebody is investing into the business, okay, as a debt holder or as a debenture holder or as a creditor, what it means is that what? It becomes a liability that is increasing. So that means that what? That liability will increase there. That's a credit. Then when the money enters the bank, of course, that will mean that our assets will increase. That is what? A debit. So it means that upon the receipt of the fund, upon the arrangement where, okay, money is raised and then payment is made into the bank, what we do? We debit our bank here. And then what do? We credit our what? Liability, which happens to be the debenture holders. All right. So this is basically a simplified way of explaining what they call the bonds or the debenture uh, method of raising funds for the business. Don't forget that debenture holders or debt holders are not the same thing as shareholders. While shareholders are seen as owners of the business, debenture holders are seen as investors to the business. Of course, shareholders are also investors, but the arrangement is different. One person is more like the owner of the business, the other is more like a creditor, someone who is lending the business money, okay, and hopes to get it back, at an agreed period of time, and then hopes to also earn interest, whether profit is made or not. But the shareholder in this case, of course, hopes to earn dividends, of course, where profit is made. All right. So this is a summary of accounting for bonds, or what we call debenture. All right. And then if you have questions, you can read the numbers displayed. I'm going to reply you with the right answers. And this very simple question, so we understand the idea around what debenture. Okay. So let's go here. What do we have? We have the following travelers was administered from the books of Judah Mega PLC for the year ended at 2019. So we have sales, 400 million, non-current asset, cost of sales, admin and selling expenses, debtors, cash at bank, vendors. Okay, and then what else do we have there? 100 million on each share, 1 naira each. Then we have additional information there. So the business raised the long-term fund through a 7% fixed redeemable debenture of 100 million naira. While the bond agreement was concluded in the year under review, interest payments was agreed to be paid from the first day of the following month. Okay, closing inventory. There I can see 1.2 million. Accrued expenses amounted to what? 3 million. The business depreciates. Depreciates non-current at 10% per annum. So you're required to prepare income statement with the end of 2019. So this is a very straight question. Let's quickly look at it, and then we can quickly, resolve what we're trying to do here, so that you understand what we're talking about here. So basically, what I can see here, okay, let's be fast. So we have Judah Mega PLC. Okay, so what we have there, we have income statement. Okay, for the year ended at the 1st December 2019. Okay, so let's call this our notes. So of course the first thing here is what? Turnover. Let's call it note 1. Okay, so we have note 1. What's the note 1 there? Okay, I can see sales. Sales there is 400 million. I think that's about the only thing there. So we have sales here, 400 million. So the next one we have cost of what? Sales. That will be note 2. So let's call that note 2. Okay. So what are the cost of sales there? Oh, they are giving to us directly there. I can see cost of sales there, 202 million. So we have cost of sales, 202. But if you look at the additional information, I can see closing inventory. So that means they have some closing stocks there. Remember, it's also part of cost of sales, 1.2 million. So of course, we're going to less closing stock or closing inventory as I see 1.2 million there. Right? So what do we have now? 0 minus 0 is 0. 10 minus 2 is 8. So there's 1 minus 0 there. So it's 0, so it's 2. So this is the cost of what? Sales. 200, 800. So take this out of this. 0 minus 0 is 0. 10 minus 8 is 2. So be 9. And this will be 9 as well. And what do we have here? 3 minus 2 here will be 199. So this is your gross profit. Okay. So is there any other income according to the question? Any other income? No other income. So let's move on. So we're going to have total expense. That will be note 3. So let's have our note 3 here. Okay. So what's our total expense? According to the question, we have admin and selling expense. So we have admin and selling. So what do we have there? 40 million. That's 40,000 there. So what else do we have? So we have accrued expense there. Of course, you know what accruals are, okay? Always. So you should take that class so we don't waste time here. So we have accrued expense. That'll be 3 million. That's 3,000 there. Okay. Then we have depreciation. So depreciate non-current assets by 10%. So what are the non-current assets there? Non-current asset is 180 million. Then what's the depreciation of that? So we have depreciation. So that will be 0.1 times 180. So what do we have there? We have 10 over 100 times 180,000. So what do you have? This. Otherwise, I can say 1,800. 1,800. So what else? Is there any other thing there? Did the business raise the long-term funds through 7% fixed redeemable debenture of 100 million? While the bond agreement was completed in the year under review, interest payment was agreed to be effective from the first day of the following month. So that means that, of course, there was a debenture arrangement to raise funds, but the interest on it is not due to be paid in the year under review. So it will be paid so we'll start counting the following year. So that means the interest payment or interest element is not going to come down under the, or it's not coming in the accounting period yet, because the agreement is that we'll begin it from the following period. But then the fund was received in this year, so we account for the fund received in the year. Okay. So what else is there? So we're through, done almost everything there. So what do we have? Total expense there. Okay. What do we have there? We have 40,000 plus 3,000 plus 1,800. So what do you have? 44,800. 44,800. So when that comes here, 44,800. What do we have? 199,200 minus 40. So we have 154,400. Okay, so this is your profit for the year. Remember, this is a reserve. Okay, so of course you can take it further to want to calculate your earnings per share, your tax, profit after tax. But this is profit before tax. Anyway, profit after tax, then undistributed profit and all that, bringing in dividends and all that. I've taken that class, so you can just take those classes. Let's move on. So this profit for the year, this becomes what? Part of your reserve. Of course, when you try to appropriate or distribute, you deal with them accordingly. Okay, so what's the next thing there? Let us not forget that we have what? Statement of what? Financial position as at what? 31st December 2019. Yeah, so we have our notes. Okay, so this will be what? Assets. So let's call it non-current. That will be note 4. So we have note 4. Non-current asset is 180 million. So we have non-current there, 180 million. Take out your depreciation, 1,800. So this is your carrying amount. So what do you have? 180,000. Excuse me please. This here is supposed to be 18,000. So this is 18,000. 18,000. Okay, 10% of 180,000 is 18,000. So 18,000 plus 3,000 plus 40,000, 61,000. So this is supposed to be 61,000. So here we should have 61,000. Of course, that will be, so this is supposed to be 138,200. Okay, So this is supposed to be 18,000. Okay. So 180,000 minus 18,000. This is 162,000. Okay. So that means here we have 162,000. So what are our current assets here? Our current, let's call it 5. So we have note 5. What do we have there? Debtors. What are debtors there? 43,000. Then we have bank. Our bank has to change. Remember, we issued debentures. Okay. So if we go by our double entry, we're going to have what? Bank, right? So balance brought forward here. What do we have? In the bank, 55 million. That's 5,000. Okay. Now we issued what? Debenture to raise 100 million. So of course, we're going to have our 7% debenture here. That will be 100 million. So that means our bank will increase to what? 100 million plus 55 million. That will be 155 million, right? So brought down to 155 million. So that means our bank here is 155 million, right? Is there any other thing there? Closing inventory. Closing inventory there, that's 1,200,000. Any other thing? No other thing. So let's go 43,000 plus 155,000 plus 1,200. What do we have here? 199,200. We have 199,200. Okay. So if you add up this, what do you have there? 162,000 plus 199,200. So this is 361,200. So represented by what? Our liabilities here. So we have short-term liabilities. Let's call that note 6. So yeah, we have note 6. So what are the short-term liabilities here? You can see vendor. How much is the vendor there? We have vendor to be 20,000. Okay. So what else do we have there? We have accrued expenses. We have accrued expense. That will be how much? 3 million. That's 2,000. So any other thing there? No, so this is 23 million. So we have it as 23 million. So we have long-term liabilities there. Let's call it note 7. So we have note 7. So what is long-term liability? That's the debenture. Of course, we issued debenture. Asset has increased. Liability also increased. Debit asset, credit what? Liability. So we have 7% debenture. You can use the word bond if you want to. So of course, money has gone to the bank. So we have bank there, 100 million. Of course, we have 100 million. So that means here we have 7% debenture. So this is 100 million. Okay. So what's the next thing there? What's the next thing there? What's the next thing there? So we have our, what's there? Reserve. What's our reserve? Let's call that note what? 8. Let's put the note 8 here. Our reserve here, of course, is the profit for the year. Profit for the year. 138,200. So we have 138,200. So what's the next one there? Our ordinary share capital. Question says 100 million. So we have 100 million. So add that. So what do we have here? 23,000 plus 100 plus 138, 200 plus 100,000. We have 361. So we have total liabilities here. Now have what? Total asset. So you can see total liabilities 361,200. Asset is 361,200. So this is basically an accounting, for bonds or debentures. So the simple understanding here is that debentures, or more like liabilities, of course, raising funds, okay, by getting investors to borrow the business money over a particular period of time. So you can go through it. If you have questions, you can reach me on the number displayed. I'm there to reply with the right answers.